Hey guys, it's Jason Postel, JP Capital Solutions. I'm going to go over today the basically the proposal. We did the last training on the cash flow analysis where we walked you through how to underwrite a deal. Right? We plugged it into the deal check, into the free software you can use just to spit out an evaluation to find the basic metrics that most investors and buyers, sellers are looking for, right? Cap rates, cash on cash returns. But today we're going to dive into a little bit deeper of a package. So if you don't have the free software is the deal check that you can get. I have the link in here. You can grab that for free. This package is a custom package that has built. If you're a broker with our company, you obviously have access to that. If you're seeing this somewhere else, you can always go to crepropackage.com/OM, like offering memorandum. So that's CRE, like commercial real estate, propackage.com/OM, and you can get the package similar like we're going to go through. But either way, if you don't know how to underwrite the deal in the first place, you're not going to have an opportunity to even get in front of a seller or investor to even show them this, right? So you need to first know how to underwrite it, and then two, you need to know how to walk them through it. So today we're going to just go over a deal that we have. It's a little 15 unit. We used the cash flow, the profit and loss statements from the last training we did, and we went over it. So we're going to do the same deal here. We're just going to go through more line items, more metrics. It's going to be a little bit deeper dive. And I'll kind of walk through like a situation like you would be presenting this to a seller or a potential seller on a second meeting, right? We've gone over the cold calls, the database, right? How do you find these properties? We've gone over the cold call to structure that. We've gone over the first appointments, right? How do you get the information to even be able to underwrite it from them at the first meeting that they probably don't even want to be on in the first place? But now this is going to kind of be two trainings in one. It's going to be kind of like a second appointment where you're presenting the proposal, the offering, the evaluation. And the second part is knowing how to go through these line items, what metrics to look for. So it'll be good to add on to the evaluation and underwriting. So here it is. Let them know what they're looking at. You're always going to want to have your executive summary. You're going to want to show them, what is the investment summary? What is the business plan going in? What is the description? All of this, the seller obviously knows, and some stuff they might not, but you want to impress them. This is your basically interview, right? And I've had these packages just sell themselves, really, and I just knew how to walk them through it. So, all this plays a factor, guys. You'll see some agents, brokers, just whips one page little sheet together from an Excel, and it's not very impressive. So the competition, if you're not putting something similar like this together, you're not going to have a shot. So with this, you're going to have your market comps. You're going to have the sale comps, what's on the market, what has sold recently in the last couple of years that's similar to that asset, and the financial analysis. That's the most important piece. That's going to be what spits out the evaluation. And again, that's what we went over in the last training on the cash flow analysis. If you haven't seen that, I suggest you go back to understand how to come up with your net operating income, what line items to put in, what line items to leave out. And then you got your demographics. You got a little snapshot that's always good to show the market. Maybe you're trying to sell this to an outside investor, and it's great when you can just give a high-level overview of the market, what kind of income, what kind of age range, et cetera. So very important piece. Got your disclosures. Okay. So this happens to be in the shores. I would breeze through this one if you're sitting there in a meeting, this page, because this has the offering price. And the first the only thing really that the seller is going to want to see at this second presentation, they're not going to want to hear, see, or talk about anything else other than what do you think their property's worth. That's all they're going to really care about. So you don't really want to lead with the price. You want to show them how you came up with this. You need to understand the net operating income cold, right? You need to know the comps and their relevance. You need to have the seller's current net operating income versus the potential buyer coming in is net income, right? They're going to operate potentially differently. One might not have a manager. One will have to use a manager, the taxes. So again, we go over all that in the analysis underwriting. What are the potential objections? You got to have these in mind, and what are the answers to those, right? So prepare also a net proceeds sheet. Sometimes I do throw these in the package where you might say, well, what's a net proceeds sheet? It's basically if you did sell their property and you had your commission lined up, everything, what are they walking away with, right? Maybe you know that they had a mortgage. Okay, well, they sell it for $1 million and they had 700. Are they walking with 300? Well, your commission might be 100. So their net cash proceeds would be 200 grand at that point, right? So anyway, this sheet again is a great snapshot, but I would not let them really even see the price. Kind of breeze through it. It just kind of goes through the summary here of the offering. It shows some proposed financing terms. You might just want to say, hey, for this underwriting, we put in that we were using 80% leverage, right, at a 3.25% interest rate since they're low. It's on a 30-year AM, and it's a 5-year balloon. So you can just kind of show what you're walking through. And if that just went over your head, that's okay. It's just the terms of the loan that you're letting them know. Oh, hey, remember earlier when I told you the loan, 20% down? Well, this is how you get what they call the cash on cash metric now, right? So again, that's all in the cash flow analysis. Go back, read that if you have no idea what I'm talking about right now. So here's a property description. Again, they will know, but it's always better when you show them, and even better if you can show them or tell them something they don't know, right? So make sure you get good pictures. Here's a little bit more utilities. This is current, what they pay. Little aerial views. Here's the asset, 3 buildings, 15 units total, 200 yards from the beach. I don't overload this thing with pictures. I do have some interiors, not in this package, but this is a numbers deal, right? So they're going to obviously want to see the inside. They're going to want to see stuff, but they want to know the numbers. That's what this is. This is the beauty of this business. It's a numbers. You'll hear me say all the time. It's not an emotional, for the most part. Yes, they might get caught up in the area or some other items, but it's all numbers. So again, to get to your evaluation, you did not pick this up. The market dictated this. Other properties are going to show what's the going cap rate. We base this on income as commercial. So here's the first section of on-market comps. Okay, you're going to show them right now, just so you guys know, it did show in this slide right here. It showed the price per unit. You can see it's $86,667 per unit. So you can touch on these to the seller and say, look, the valuation came out to about 86 a door. We're just under a 7 cap. The market's more around an 8, but we'll get there. And then you at least are starting to manage his expectations while you're going through this. So again, 86 a door we have it at. These are on market comparables right down the road. You can see even right here, it shows 1.1 mile away. This was 88 a door. This is on the market right now. This one's a little bit less. It's 84,000 a door, right? So these are on market right now, and here we are, the 86 a door. But what's more important is the sales, right? You want to have sales. And you want them close. This is beachside, so this first one shouldn't have even really been in here. See how it's 68 a door? It's on the other side of the river. It's not even beachside. So Here's another one. This is Beachside 85 a door. This was a closed sale. Okay. Here's another one, 106 a door, another closed sale. These are all closed, 88 a door. So see, these I can justify, if the seller thinks, oh, it's 100 a door. Well, yeah, a couple of them, you're right. This one was a newer block. There's no asbestos siding coming off. The roofs are new. It's right across from the beach, instead of 200 yards. So, for the most part, look, here's another one, 76 a door. So if he's holding firm at 100 and thinks it's worth that, well, again, these are all based off the cash flow, which, will reflect a price per door, but you can come up with different numbers based on the income, right? So that's what's most important. So again, put the closed sales that are similar to the asset. Notice that I'm marketing a 15 unit property. I have an assignment for a 15 unit. So everything's going to be over 5 units in this range. Here's another 15 unit. Here's 17, 9, 8. These are close enough and I did a lot of the 8s and 9s because that's one of these buildings, the brown one in the picture. It's a 9-unit building. So these are very close. And then there's your map. So at this point, he's going to understand, okay, this guy's done his homework. Whatever he's going to show me now in the evaluation, he's not going to be able. It's not just you as you could be a new broker. This could be your first appointment or second appointment, but your first deal ever. So you might even feel like, oh, I don't have the track record or credibility. Well, you do, because now you've done your research, you've done your homework, and now you can show them this is what has closed. This is what I have found based on the numbers you gave me and the income compared to others alike, and here we are. And they'll respect that. So you don't need to be a seasoned pro. Okay, so now we're diving into the financial analysis. Okay, here's the current numbers. There's sometimes you can go 2-3 years out, and I do have other slides we'll get to that show this, but you're always going to want to show them the current income that they gave you. They will know. Then you want to have a realistic pro forma. A pro forma, if you don't know the term, it is a projection. If you think pro forma, think projection. It's a futuristic look, right? It's a look into the future on what the next year or two are going to look like. So for example, it's not this that I'm going to give you an example on, but let's just say that you have a 20-unit building and it's currently 50% occupied, okay? Well, as a new owner, you better hope, well, hey, something's going on. How do I fill those other units up? Well, the pro forma, the projection, what I'm going to do as a broker or investor underwriting it, right, is I'm going to go to a reasonable vacancy rate and say, hey, if you fix these up and lease these up, the going vacancy is only about 5%. So you could put all of the gross income for those 20 units, subtract the vacancy, and then that would be a realistic pro forma, okay? And the taxes, so one thing right here, I'll get into this, I'll show you the comparison. So you're going to walk them through. You're going to say, okay, look, these were the numbers you gave me, correct? Boom, boom, boom. They're going to say, yeah, okay. Okay, well, these are the numbers that an investor coming in are going to see. Your taxes right now, you can show them, are 10,000. Oh, they might say, oh, I'm not paying 20,000. That's crazy. Well, you're not. But what's going to happen is if you sell this for what you're wanting to, and we're going to get to that evaluation, they're going to be reassessed. And a lot of people forget about this or don't underwrite it going in. They miss that. It's a huge increase if an owner has purchased this thing or inherited it from the 80s or 90s or even before for a song, right? Well, if they got it for $100,000 back then and now it's $1 million, guess what? Taxes paying on $100,000 are going to be a whole lot different than $1 million, right? So that's what some people don't account for, and that's when they get hurt or burned on that reassessment. So make sure you're putting those in. Again, these are each line item. I've seen pro formas and packages where brokers or people aren't even putting in, insurance or a management fee. And sometimes there isn't a management fee. I have an assignment right now where the owner manages it himself. He doesn't have a third party. So he just keeps that as more cash flow. But you have to put that in because a bank is going to assume there's always going to be a 5% vacancy and a 5 to 10% management fee. Okay, that's just how the bank's going to do it. So that's how we do it. So here's the line items you break down, and you can go line item by line item if you want with them. So right here, this is going to show the projection all the way through year 10. So as you can see, you can let them know, hey, we did across the US, 3% annual increase in rents has been about historically what happens. You'll hear some markets, oh, there's been an 18% increase, or oh, they only went up, a percent. Well, it didn't, but the average, right, is 3% annual increase. And some of you that might be living in an apartment, you might realize that. Okay, well, what's 3% increase? Well, think about it. $1,000 a year or a month. I'm sorry. Then if you're getting a $30 increase, well, there you go. That's pretty common. 15, 20, $30 a year if you're at an apartment or somewhere like, right? So with that though, you can't just think, oh, every year it's going to increase and then all the expenses are going to same or decrease. No, those expenses, inflation, right? That's what inflation is. It's expenses. So, payroll is going to get more expensive, contractors, landscaping, all of it. So that's a 2.5. It's not as much sometimes. Again, it's subjective, but you want to put that in there. Okay, here's the value add rubs. We went over this in the last training. If you remember, it was ratio utility billing system. Some call it residential or resident utility billing system. Again, all that is a way, as you see 0, at the beginning of this deck, it showed owner pays utilities. Owner pays all utilities, right? Electric is only accounted for in here that he doesn't. So he's paying all that. So that's a huge value add. If you separately meter them, or again, the utility ratio, it's a ratio utility. You can just, if they're on 1 meter, if it's $10,000 a year for 10 units, you can just divide that up, under $100 a tenant, and you just bill them back and reimburse yourself as the owner. So that's why I did put that in here as a pro forma, because that's a realistic value add that you would call that. Oh, great. Yeah, we can put 20,000 more into our pockets by doing this. The owner coming in. Okay, that's great. Management fees. Again, here's the taxes. So your net operating income here at the bottom line. This is what you're going to base it off before. The NOI is how you get the cap rate. Now, the annual debt service, if you're paying cash, you obviously will not have this line item, but it's very important to get other metrics like the cash on cash and IRR, that this is in here. And if you remember, we said it's a 20% down payment, 80% leverage on the 1.3. That's going to be $50K a year. So your net cash flow is $31,000 on this. And again, this is all after your net operating income, which gives you your cash on cash. So if you do the math to get a cash on cash, so if you see the first line item right here, the 12%, it says 12.1, then you say, oh, cap rate's 6. Well, if you don't even know what a cash on cash metric is, then you're not going to know how to explain it. That's for sure. So we talked about last week how to come up with that evaluation. Again, go back and look if you need more help, but just again, a short little synopsis of what cash on cash is, just so you can follow, is you take the net cash on hand. So in this case, it's $31,552. Okay, and you divide that by your initial down payment. So in this case, it was 20% of the 1.3. So you're looking at 260,000. There was some other costs, so it'll be close. But you divide the net cash, which in this case is 31,000, and you divide that by your capital investment, which is $260,000, and you get an 11.9 or 12.1 cash on cash. That's how that is made. Okay. So again, go back and learn that. That is very important because see, a 6.6 cap rate, that's kind of aggressive, which aggressive means it's pretty, it would be priced high. The lower the cap rate, the higher the price, right? It's an inverse. So when I say aggressive, it's a pretty low cap rate, meaning it's pretty high price. It's not too, for this market, it's not too aggressive. It's kind of in line with the market, but it is a little low. The 6.6. I think getting into this deal, I'd feel comfortable at a 7.5, closer to an 8 cap. Now you can see year two, it shows an 8.8. So I would feel good if I could execute my business plan, right? But again, the 6.6 is from taking the 85,000. You'd go 85,867, and then you just divide that by the purchase price. Okay, this is how you get the cap rate. You take the net operating income. Okay, so this is without the debt, without the cash flow, and you divide that by the purchase price, which this is 1.3. So again, you can do it on your calculators right now just so you can understand it. 85,867 divided by 1.3 million, and you will see that 6.6 right here, cap rate. Okay, now I know I'm getting back into the analysis, cash flow analysis and underwriting like last week, but I think it's good just to keep reiterating this if you're learning it. But if you are trying to come up with the evaluation, if you don't have a fancy financial model and you're just trying to do it on the fly, again, I had already gone over this, but if you don't have the purchase price and you're trying to figure that out, because that's what a lot of people say, oh, well, yeah, if you have the purchase price figured out, then great. Well, how do I get the purchase price? Well, if you don't have the purchase price, how do you come up with that? Well, you take this same NOI, you can get just their profit and loss statement and come up with this number, okay? If you've done your homework and you know, okay, if an investor asks you, oh, well, what's an apartment building going for? Cap rate. What are the going cap rates? You'll get that a lot. What's the going cap rate there? 7 cap. Okay, so a 7% cap rate. If you knew those two things, the net operating income and a 7% cap rate, what would you do from there? Well, you take the net operating income of 85,867 and you divide that by the going cap rate, which in this case it was a 7%. So it's 0.07. That's what you divide it by, and it would spit out an evaluation of 1.226. Okay, so and if you know this stuff cold, you will impress the seller, because now if you knew he had wanted close to the 1.3, you can tell him now, hey, Mr. Seller, the market cap rate right now is closer to a 7. I know this evaluation spit out about a 6.5, but just to let you know, this isn't me picking the price, that off your current net operating income, so again, 85,000 divided by the going cap rate, 7, spits out a $1.2 million evaluation. So you can tell them, hey, we're close, we're at 1.23 or 1.23, so you're close, but at least you can justify price reductions, and you sound, and more importantly, you know what you're talking about, right? So just keep watching this or go back to it. That's how you're going to come up with the two most important, or that is the evaluation, right? Cap rate or number. But again, one's based off just the cash flow. The other is based off net operating income. And just to be clear, cash flow, you think the net cash flow, That's after any debt, and that's your cash on cash metric. Net operating income, that's before your debt service, and that's how you get the cap rate, okay? So I know that was a lot, but that's very, very, very important. So here we go again, back to this. We have the cash on cash. And I love the cash on cash because historically or traditionally or typically, whatever you want to call it, oftentimes is a larger number than the cap rate. So as you can see here, the 6.6 is half of what the cash on cash. So if you're selling this deal as a broker or an agent, you say, if you have a guy that just is harping on a 7 cap or an 8 cap, you say, Mr. Investor, look, I understand the cap rate is a little compressed, right? It's a little low, but you can get great debt on this. You can get a double-digit cash on cash return. Okay, he might not even know what that means. He's gonna be like, what? But he's gonna hear double digit. He knows what double digits are, right? That's 10 and up. So he's like, well, what do you mean? Well, there you go. Just go back to what I just went over. Well, 12%. Now, what I mean by that, your initial investment's gonna be 200 grand. This thing's gonna be kicking off 30,000 net in your pocket. That return, the 30,000 over your 200 grand, gets you that double digit. Okay, so again, guys, I'll say it over and over and over until you hear it. But I mean, that example I just gave, 30,000 on 200 is a 15% cash on cash. But you guys get it. And if you don't, just keep going over it. The other item here is a debt coverage ratio. This is a great number just to keep the seller in line, keep his expectations in line, because a bank, unless he gets a cash offer, which that's what they want, of course, but that's not always the case. You're going to say the banks, right? This is never you as an agent thinking you got it all figured out and you know it. They don't want to hear that. They don't, even if you do, they don't want to know that. It's you are an advisor. You're advising them on different scenarios, and guess what? They get to choose. Okay, they're going to choose. So the more confirmation, or I guess the more sources that are third party or the market, and not you telling them, oh, I just came up with this, it's not only going to build more credibility, it's just going to put it in better perspective, because it's not coming from an agent or broker that's trying to just sell their property or get a number, right? So I'm saying all that to say this debt coverage ratio is what the banks look for. So if a bank's going to give a loan on this, what they look for, the minimum, is a 1.25 debt coverage ratio. Okay. If you don't know what that is, go to the terms. Okay. I have all the glossary. You go to www.jpcapitalsolutions.com/glossary. You can get all the terms and study them and get familiar. But the banks will look at a 1.25 coverage ratio and up and above. So that means the NOI has to be 1.25 times greater than the loan payment. Okay, so if that just went over your head, to put that in perspective, that $54,000 payment has to be greater than the net operating income that the property is bringing in. Okay, go over debt DCR, DSCR, debt service coverage ratio, and learn that too. But this is great because you can say, if it is lower and the valuation is off, you can say, look, this wouldn't even qualify with the bank financing. Okay, so and again, here's your realistic underwriting with expenses. Rule of thumb is 50% just off the fly on apartments. So here you are, 49%, you're right on board. Now, if you build back the utilities, you're cutting a huge expense. So now you're still in a reasonable, fair, realistic number, expenses. So these are just great numbers, great metrics that you can explain. And here's another one that I'm not going to get into the IRR exactly, but that's an internal rate of return. So just to give you a high level overview on what that is, right here, you'll see 36%. That seems like, oh, that's a big number. Well, what that is that is the proceeds. So after the life, this is based off of 5-year. See how it'll change 10 years, obviously the numbers. This is your internal rate of return. So this is your capital that you will have gained after every year of cash flow after debt service, and the plus the proceeds, right? So what are the proceeds after you sell and pay back loans or whatever? What's your initial investments return at the end of it, right? So again, for this example, it was 1.3. You had to put 20% down. That's 260. Okay, your loan proceeds are going to be 688 at the end, and so you divide your initial investment of the 260. You get the 688,000. You divide that, and you get your 36.32. Okay, so if that flew over your head again, go back over this. But that's another important. That's a higher level metric, but you got to know it, and you start getting into institutional advisors, brokers, owners, investors. That's a very important metric for them. Okay, so that's in here. That's another great metric that you need to study, learn, know how to come up with it. Just know how to talk about it, and don't just like guess at it. You know, if you don't know, you don't know, but tell them you'll figure that out. Okay. So the demographics, again, they're going to know it as a realtor. You can't really say, oh, white people live over there, black people live over there, this is a Chinese neighborhood. You can't, they call it red lighting. You can't, but you know what, there's these are pulled from a source of Asri. That is a data collection agency throughout the U.S. And it's real numbers. So, you know, it goes back from 2000 and it shows even 4 years ahead of time. You know, what is the population growth? Well, this looks good. There's going to be a 5% increase in population, you know, through 2024. This is a good market. You see, household, what is the occupancy? What is the incomes? Okay, well, a mile from here, you know, the average income is 59,000. That's a pretty good income average, you know, for the area. I think the average in this county is like 30,000. So, you know, it's almost double. Again, you're at the beach, in the mile, you got a lot of oceanfront homes and higher income. But anyhow, it just shows, you know, the population. What is the age ranges? What are you know, what kind of tenants are you going to be showing? Again, this is what you're showing a seller that might know this, might not, or you've already gotten the assignment and you need to know how to convey this to an investor, right? So you know, again, this shows different race and ethnicities that, you know, again, you can't just tell them, oh, it's this or that, but, you know, it shows. This is, again, data that's collected. It's just, it's out there for everybody. It's public information. So it's good to see it, good to show it. And, you know, of course, have your contact information, pretty little picture of your face. So if you're meeting with them and they didn't give you the assignment yet, you have a nice 40-page deck on their desk with your name, your number, your email, and easy for them to get a hold of you. So, you know, this is a great way to not only earn assignments, but sell them. Just to have, you know, a professional, you know, and I don't even want to say it's different, you know, because as I told you earlier, if you don't have something in a package like this, or underwriting capability, then you don't even have a chance. I'm not saying you have to have a 50-page deck, like this, but at least that deal check, you need to be able to come up with the evaluation, okay? Other than on a pen and paper or just a one-page Excel spreadsheet. So I have other tools, other resources, that are great, but this is just huge for, again, getting the assignment, getting the listing, and selling it, more importantly, right? Because you can get assignments all day. If you don't sell them, what good was it in the first place? So hope that helped. I know I threw, again, a lot at you guys. I didn't want to make this all about the underwriting. I wanted to more explain kind of the second proposal process, how to, walk them through it, take control of this, guys. One thing I didn't bring up, which I will do another one of these on just the second appointment. I'll go over this more in like a role play format, just to kind of show you what kind of questions, answers, how the seller might want to take control of that meeting. You do not want them to do that. I've made the mistakes of teaching the seller at the very beginning of the meeting how to come up with the cap rate. The entire meeting from that point on was all him in his own head, because I saw his eyes look up and just figuring out numbers the entire time. He just wanted to come up with it, and you could tell he was playing with the numbers in his own head to try to figure it out, because he didn't even want to wait to get through to the underwriting for me to show him and tell him how I came up with it, and he was just trying to do it on his own. So don't make that mistake. Take control of the meeting, keep control of the meeting, manage their expectations early on. And, if you know this stuff, Cole, guys, how you came up with all of these line items, you're going to do well, and you're going to impress them. You're going to impress the investors, potential purchasers, and you're going to get a lot of business doing so. So hope it helped, guys. And like I said, I'll do the next training here on a second appointment, more on a I don't know, whatever you want to call it, a walkthrough or whatever. I'll do a second appointment, just like a mock kind of presentation. So again, hope it helped, and happy to help however I can. See you guys on the next video.